As China continues to buy up gold at a historic pace, it is simultaneously shedding its holdings of U.S. Treasury bonds, a move that highlights both an economic and geopolitical shift with profound consequences for America's financial stability. Welcome viewers to my channel. Please subscribe, like my video and turn on notifications so you don't miss our next update. According to newly released Federal Reserve data, China sold another $22.7 billion worth of U.S. Treasuries in February, reducing its total holdings to $775 billion. That marks a steep decline from the roughly $1.1 trillion it held in 2021, putting its Treasury portfolio at the lowest level in over a decade. China is still the second largest foreign holder of U.S. debt, but the United Kingdom, currently in third place with $700.8 billion, could soon surpass Beijing if the trend continues. Japan remains America's largest creditor, holding about $1.17 trillion in treasuries. This steady divestment is not an accident, it is strategy. Chinese policymakers have watched closely as Washington has wielded the US dollar as a geopolitical weapon. The dollar is the world's reserve currency, and most international transactions run through it. That means the US can use its financial system to freeze assets, impose sanctions, and exert pressure on foreign governments. A recent example came when Treasury Secretary Janet Yellen suggested seizing Russia's frozen dollar reserves and redirecting them to Ukraine. For China, this was a stark reminder that the US could easily target them in a similar way if relations deteriorate further. The logic in Beijing is straightforward. If your exposure to the dollar makes you vulnerable, you reduce that exposure. By trimming Treasury holdings, China is slowly pulling away from a system where Washington holds all the leverage. At the same time, Beijing has been aggressively stockpiling gold, an asset that carries no counterparty risk and cannot be sanctioned or frozen by foreign governments. The People's Bank of China (PBOC) has reported 16 consecutive months of gold purchases, adding more than 300 tons since late 2022. But even these official numbers may not tell the full story. Analysts have long suspected that China keeps part of its gold holdings off the books through the State Administration for Foreign Exchange (SAFE). Estimates suggest that China could have several thousand tons of unreported gold, giving it a much larger reserve buffer than publicly acknowledged. This dual strategy, dumping treasuries while hoarding gold, fits with Beijing's long-term goal of reducing reliance on the dollar and building a more independent monetary foundation. China's retreat from U.S. debt underscores a growing crisis for the federal government. Washington continues to run massive budget deficits month after month, meaning it constantly needs new buyers for its bonds. If one of the largest foreign creditors is backing away, the obvious question becomes, who will step in to fund America's borrowing habit? Foreign investors account for about one-third of the U.S. Treasury market. In theory, the domestic market could absorb more debt, but there's a catch. The Federal Reserve, which has long been the single largest holder of treasuries, is currently scaling back its holdings rather than expanding them. As of the end of 2022, the Fed owned more than $6 trillion in treasuries, representing 35% of all domestically held bonds. By purchasing so much debt, the Fed artificially suppressed yields and made it cheaper for Washington to borrow. But under its current quantitative tightening policy, the Fed is letting bonds roll off its balance sheet to fight inflation. In other words, both China and the Fed, the two biggest buyers, are now either selling or stepping back. With fewer willing buyers, the U.S. Treasury must offer higher yields to attract investors. This is one reason Treasury yields have been climbing, even as many expect the Fed to eventually cut interest rates. Higher yields, however, mean higher borrowing costs for the government. The impact is already severe. In just the first half of fiscal year 2024, the U.S. government spent $522 billion on interest payments alone, a staggering 36% increase compared to the same period in 2023. In fact, the only budget item that costs more than debt interest is Social Security. This growing burden creates a vicious cycle. The more the government borrows, the more it must pay in interest, which in turn requires even more borrowing. Many analysts believe it is only a matter of time before the Federal Reserve is forced back into the market with another round of quantitative easing to keep borrowing costs under control. But that would mean printing money to buy government debt, a move that risks fueling another surge in inflation. And inflation, of course, is ultimately a hidden tax on the public. Prices rise, purchasing power falls, and everyday citizens shoulder the cost of Washington's financial mismanagement. China's strategy is clear: reduce vulnerability to the dollar, diversify reserves, and strengthen independence with gold. For the US, the consequences are equally clear: fewer foreign buyers for its debt, higher borrowing costs, and a looming dependence on the Federal Reserve to bail out the Treasury. If these trends continue, Americans may face not only higher inflation but also a fundamental erosion of confidence in the dollar itself, the very foundation of the global financial system. While headlines often focus on military tensions in the South China Sea or political sparring over Taiwan, another battlefield has been quietly taking shape, one far less visible, yet potentially just as decisive. It is not fought with aircraft carriers or missiles, but with currencies, reserves, and financial leverage. China's pullback from U.S. Treasuries and its pivot to gold is not just a monetary decision, it is a geopolitical maneuver, part of a broader strategy to challenge the dollar's global supremacy. For decades, the dollar has been the undisputed king of international finance, the reserve currency trusted by governments, corporations, and investors around the world. That dominance gave Washington a unique weapon: the ability to fund itself endlessly, impose sanctions, and dictate financial rules across the globe. But Beijing sees that empire of paper as vulnerable. By cutting reliance on U.S. debt and strengthening its gold reserves, China is signaling that it does not intend to remain trapped inside a system designed and controlled by America. The shift is not happening in isolation. Across the globe, a quiet but growing movement known as de-dollarization is gaining momentum. Russia, cut off from Western financial systems after the invasion of Ukraine, has pushed aggressively into non-dollar trade. Middle Eastern energy exporters, including Saudi Arabia, have openly discussed pricing oil in Chinese yuan. Even longtime U.S. partners in Asia, Africa, and South America are beginning to experiment with alternatives to the dollar in bilateral trade deals. China is at the center of this shift. Through initiatives like the Belt and Road, it has expanded its influence by offering loans, infrastructure projects, and currency swap agreements that tie other nations closer to the yuan. And each new trade deal settled outside of the dollar weakens Washington's financial chokehold just a little bit more. Gold plays a critical role in this emerging financial battlefield. Unlike paper currencies, which can be devalued or frozen with the stroke of a pen, gold exists outside of political systems. It is tangible, scarce, and universally accepted. By stockpiling gold, Beijing is building what many analysts call a shadow currency, a reserve foundation that could eventually back the yuan or support an alternative trading system. The idea is simple: if trust in the dollar erodes, nations will look for stability elsewhere, and gold provides that ancient guarantee of value. Some economists even speculate that China may one day reveal its hidden reserves, instantly announcing to the world that it holds far more gold than believed. Such a revelation would send shockwaves through global markets, shattering confidence in the dollar and accelerating the shift toward a multipolar financial order. For Washington, this trend is deeply unsettling. The U.S. government's ability to borrow cheaply depends on the world's insatiable demand for dollars and treasuries. If that demand weakens, the cost of financing America's deficits will rise dramatically. Already, the warning signs are flashing. As China and other nations reduce treasury holdings, yields are climbing, forcing the U.S. to spend hundreds of billions more on interest payments. If confidence in U.S. debt continues to erode, Washington may soon face a crisis it cannot paper over with promises of future growth. The irony is stark. For years, the U.S. relied on the very nations it considered rivals to fund its spending habits. Now, as those rivals retreat, America finds itself staring at the uncomfortable reality of its financial dependence. What is unfolding is nothing less than a clash of financial systems. On one side is the U.S., defending the dollar's dominance with every tool at its disposal. On the other is China, building an alternative framework anchored in gold, yuan, and regional influence. This conflict does not explode like a war, it creeps forward in statistics, trade agreements, and reserve allocations. But its consequences could be just as profound. A world where the dollar is no longer supreme is a world where Washington loses much of its leverage, its ability to sanction, to borrow endlessly, and to dictate terms.